the difference between investing in stocks yourself versus an active mutual fund versus an index ETF versus an index FOF. There are 3-4 more verses I can add. I can probably add invest in a PMS. I can also add investing in an AIF, but let's keep it simple for today. My name is Arpit Arora. I'm India's leading personal finance expert and passive income coach. And I'm on that quest to change the middle class of India and transform their financial life in such a way that they are able to have the potential to follow their passion. They have the focus to follow their passion. They are not distracted by money because they're creating enough passive income, and most importantly, they're able to live with inner peace and joy. And that, my friends, happens by winning the game of money. That happens when you upgrade your financial IQ, and that most importantly happens when you are committed to achieve financial freedom in your life. Because it cannot happen without a commitment, and it is my commitment to make sure you get all the support that you need to walk and achieve that destination. Let's say if you invest in stocks yourself versus you invest in a mutual fund versus you invest in an index ETF versus you invest in an index FOF directly in the product. Okay? Assuming that there is no trend lines, there is no other advisor or manager for you. Let's say you're doing all of this yourself, so kya farak padta hai? So from that context. So when you are investing, when you talk about risks, when you're investing in self-owned stocks, your risk is very high. Your risk can be also equal to zero money because the company can either get delisted or the money can lose 90-95% of its value. And even certain Nifty 50 companies have also done that. So if you're investing in penny stocks or if you're investing in small and mid cap companies, so losing 90% value should not come as a surprise. So the risk here is extremely high. If you compare the same risk of a mutual fund, it's high because it's not very high, because it depends on, first, the money would not be in just one or two companies. The money would be invested with a certain financial acumen, which the investor themselves might not have. And later it depends on the type of mutual fund it is. If it's a large cap or it's a small cap fund, or is it or it's a value investing fund. So that's where the subjectivity comes. With the index ETF, the risks is medium to high because you are typically, when you're investing in an index ETF, your fall is likely going to be less than the stocks and less than the mutual funds. So it can be high when you're going for sectoral ETFs, or medium if you're going for index ETFs of mid Nifty 50 per se. So how is the index ETF and index FOF different? Index ETF and index FOF are almost the same thing. What is the difference between them? The index ETF is trading like a stock on the stock exchange. An index FOF is like a mutual fund where you get units when you buy it. But on the inside, the financial product is tracking the same. You can say, instruments inside. So index ETF and index FOF is almost the same. Just the platform of buying them is different, but it is a little different. I'll explain to you in a bit. How is it different? Then comes returns. When you buy stocks yourself, you can get very high returns out of it too. When you invest in a mutual fund, the returns can be good. We can say the reason why I don't like mutual fund is because it comes with the subjectivity of higher risk, but not the promise of high returns. So which is why I say returns from mutual funds will be medium. And third factor is that index ETFs, in terms of returns, will give you medium to high return. High in case of sectoral ETFs, and medium in case of index Nifty 50 or Sensex or Junior Nifty. Those sort of indexes will give you medium return. And same thing for index FOF. Like I told you, index ETF and FOF is almost the same thing. It's just same constitution of stocks inside it, but packaged differently. Third comes the expense. When you own a stock, when you go for like Upstocks, Paytm, Zerodha, all of these methods, the expense can almost be zero, maybe just 400-500 a year you pay, and then after that whatever you buy is, you don't have to pay anything on it. When you invest in a mutual fund, then your costs are up to 2.5% depending on what mutual fund. So SEBI has maxed out or capped the expense of a mutual fund to 2.5%. Most funds you'll find them on an average of 1.5, 1.75, somewhere in this range, most of the funds. When an index ETF like Nifty 50, if you look at Nippon Bees of Reliance, of Nifty 50, you will see the expense ratio can be as less as 0.05% as well, which is the cost taken by the asset management company. And certain sectoral ETFs can cost you up to 0.75%. Now here is where the FOF and index ETF is different, because the expense of FOF is higher. The same 0.05% alternative of the index ETF, which is Nifty Bees, if you go for the same thing in a FOF format, it is 4 times more expensive. Exactly the same thing. And another thing that I have not added here is something known as tracking error. So tracking error is basically, if say Sensex has given 10% returns, how much return has a particular company's index ETF of Sensex given? Let's say Aditya Birla Sensex ETF gave 10.1% and Sensex gave 11% return. So the gap between the two is 0.9%. So it underperformed, or the tracking error is 0.9%. Tracking error could also give you a higher return too. Doesn't mean it's a less return, that's when it's a tracking error. Tracking error simply means in the pursuit of tracking the index was how much did the fund deviate from the returns of the index it is copying. That's all. So from that context, we've seen that FOFs have a higher tracking error than ETFs as well. That's another thing that we saw, which is why we like ETFs more. Another reason for loving ETFs more than that is the very base, that when you buy an ETF, you know exactly what price you're buying it at, because you're buying it like a stock. Index FOF is like a mutual fund, so you get a price at the end of the day, that this was the closing price, no matter what time you bought it at. If you bought it in the morning or the afternoon or the end of the day, the price is the same for you, which is why we don't like FOFs. But they're better than mutual funds, and ETFs is best of these all. Finally comes subjectivity, liquidity. So when we talk about stocks, it's subjective, because if you invest your money in a stock which has no trading happening, so your money can be stuck, right? Or if the stock is in a, you can say in a circuit, it's a downward circuit, you won't be able to sell because no one wants to buy, no one wants to buy from you. So it's subjective. If it's a blue chip company, you can easily exit whenever and whatever price you like. When you invest in a mutual fund, it has exit loads. Most mutual funds will not let you take money out very quickly out of it. So to avoid that, they put exit loads on it. You can pay up to 3-4% in exit loads as well if you exit very early from mutual funds. Where index ETFs are highly liquid because they have very high volumes in it, and same for FOFs. So ETFs, but not all ETFs have good volumes. Like we've seen a surge of ETFs happening in the last 1 to 2 years, especially 2021 was full of new ETF launches. So not all ETFs will have enough volume as well. But if you look at the common and the big ones, they have ample amount of liquidity happening because it's being traded the most. The ETF with the highest volume is Nifty Bees ETF only. It has the highest amount of volume traded in it on a daily basis. The highest AUM of an ETF is SBI. I think it has more than 1 lakh crore because that's where the pension fund money is going. EPFO also puts their money in Nifty 50 ETFs. I'm sure you know that. So they are investing in SBI. So SBI is not the best ETF out of my own choice. If I was to blindly choose without doing any analysis, and there's not enough daily trading happening in it either. Whenever money comes, it comes in big volumes. But Nippon Bees ETF has the highest amount of trading happening on a daily basis. So that's one of the best ETF for a retail investor to go for. So with that, I hope we are clear with the difference between all of these three. In fact, and I've also added tracking error to it. So if you talk of tracking error in a self-owned stock, it can be very, very high, very, very high. It could simply diverge कि market कहीं जा रही है, आपके stocks कहीं जा रहे हैं. Mutual funds, it's high. It's predictably high. Index ETF is very small. FOF is also a little bigger than the ETF, but it's there.